What strategies reduce capital gains tax when selling investments? Imagine turning your investments into a steady stream of income without giving away a big chunk to taxes. That's what smart planning can do for your wealth. When you sell stocks, bonds, or real estate, you might owe capital gains tax on the profit. But there are ways to keep more of your earnings. One of the simplest strategies is to hold investments for more than 1 year. If you keep your assets longer, your gains qualify as long-term capital gains. These are taxed at lower rates, ranging from 0 to 20% depending on your income. Selling too soon means paying higher short-term rates, which can be as high as 37%. Patience pays off here, especially for retirement planning. Another effective method is tax loss harvesting. This means selling investments that have lost value to offset gains from other sales. For example, if you made a profit on some stocks but lost money on others, you can sell the losers to reduce your taxable gains. You can then reinvest in similar assets to keep your portfolio balanced. This strategy works well throughout the year, not just at year-end, especially during volatile markets. Tax gain harvesting is less common but useful. It involves realizing gains in years when your income is lower, which can help reset your investment's cost basis at a higher level. This might reduce future capital gains taxes when you sell later. Investing through tax-advantaged accounts is another key. Roth individual retirement accounts, Roth 401ks, and health savings accounts let your investments grow tax-free or tax-deferred. With Roth accounts, qualified withdrawals are tax-free, meaning no capital gains tax on growth. This is especially helpful for building retirement savings and keeping your wealth intact. Donating appreciated assets to charity is a smart move too. If your investments have increased in value, giving them to a qualified charity can avoid capital gains tax. Plus, you may get a charitable deduction, which reduces your taxable income. This strategy supports community causes and can be part of your legacy plans. Timing your sales based on your income level is also important. Selling investments in a year when your income is lower can place you in a lower tax bracket. This reduces the rate you pay on your gains. For example, if you retire early or have a year with less income, it might be the perfect time to sell and keep more of your profits. For African American investors working toward retirement, these strategies are especially helpful. Prioritize long-term investments to benefit from lower tax rates and compound growth. Use tax loss harvesting throughout the year to manage taxes actively. Maximize contributions to tax-advantaged accounts to overcome historical barriers to wealth building. Work with financial advisors who understand your community's unique challenges. And consider charitable giving that supports African American causes, helping to reduce taxes while making a social impact. Applying these tactics can help you keep more of your investment gains, grow your wealth, and build a secure retirement.